In today's video, I'm going to break down the 3 basic types of life insurance retirement plans and explain how to find the best one for your situation. There are 3 basic types of life insurance retirement plans, or LIRPs, that you might consider as part of your comprehensive, balanced approach to tax-free retirement. But there are a lot of competing voices in the LIRP marketplace who have vested interests in their particular brand of LIRP. As a result, it can be sometimes difficult to sift through all of the conflicting recommendations as you evaluate the best LIRP for your situation. So this video is an attempt to lay out the pros and cons of each of the 3 basic types of LIRPs so you can make as informed a decision as possible. In my best-selling book, Look Before You LIRP, I make the case that entering into an LIRP is a bit like getting married. It's a long-term proposition, and you want to undertake it with your eyes completely wide open. Further, it only really makes sense to begin an LIRP if you're planning on keeping it until death do you part. You don't want to get 15 years into the proposition and realize that your LIRP has a fatal flaw that could stymie your plan to get to the 0% tax bracket. The first LIRP I'd like to talk about is whole life insurance. With whole life, your premiums get deposited into the company's general portfolio that consists primarily of high-quality bonds. In a process that's somewhat opaque, the insurance company then extracts expenses from your premiums and then passes the net amount along to you, the policyholder. First, let's talk about the pros of the whole life insurance policy. First, rates of return are relatively predictable if you want to inject predictability into your financial plan and have the peace of mind knowing that your LIRP's cash value will go up each and every year. Then whole life may be a viable alternative. Not only is your cash value's rate of growth predictable, you also have a death benefit guarantee. So long as you pay your premiums, your death benefit is guaranteed to remain in force. But predictability is not without its downsides. First, you are going to experience a lower rate of return. We're talking anywhere from 3 to 5% net of fees over the life of the program. The other downside of whole life insurance is the loan provision. As a review, you take money out of your policy tax-free by way of a loan. Here's how the loan provision within a whole life policy typically works. You ask the life insurance company for a loan. They don't actually loan you your own money. They cut you a check out of their own coffers and charge you a rate of interest, let's say 7%. The whole life company will then credit you back a given rate of interest. And now here's the sticking point. That crediting rate can ebb and flow with interest rates over time. Here's an example. Let's say that they're charging you 7%, but they're crediting you back 5%. That means your net cost of borrowing is 2%. So while your distribution is tax-free, it isn't cost-free. Now, a 2% net cost of borrowing may not seem like a big deal, but every year you fail to repay that loan, the life insurance company deducts that net interest from your cash value. And as that interest continues to grow and compound over time, you increase the likelihood that your policy could run out of money before you run out of life. And that could saddle you with a taxable event wherein you could be required to pay all the tax you avoided up to that point in the policy, all in 1 year. Further, once you run out of cash value, then you lose your death benefit, even if it had been guaranteed at the outset. Take a look at the following chart to appreciate the dangers of not having a guaranteed 0% loan. Let's say you have $1 million of cash value and you want to take a $75,000 loan per year and you have a 2% net cost to borrow. That means the first year you'll owe $1,500. And if you don't pay that $1,500 back at the end of the first year, they'll take it out of your cash value. The second year, you take another loan, but you haven't paid back the loan for the first year, so they'll charge you $3,000 that year. And as each year passes and you take more and more loans, that interest begins to compound and snowball to the point where you bankrupt your policy in the 19th year at a cost of $825,000. A 1% loan provision isn't much better. You bankrupt your policy in the 23rd year at a cost of $525,000. With a guaranteed 0% loan, there is no net cost to borrow, and you take out the full $2.25 million and your money lasts the full 30 years. I don't think I'm exaggerating when I say that the loan provision is the single most important provision in the entire contract, and this is an area where I think whole life policies are deficient. In summary, whole life insurance does give you conservative and predictable rates of return with a guaranteed death benefit, but the cost of borrowing over time could set you up for a big tax surprise at a point in your life when you can least afford to pay that additional expense. The second LIRP I'd like to talk about today is Variable Universal Life, or VUL. With Variable Universal Life, instead of giving your premiums to the insurance company, those premiums get passed through the company into mutual fund-like accounts called sub-accounts. Most VULs have a broad array of sub-accounts where you can invest your money in a balanced portfolio of sub-accounts similar to a 401k. These types of returns are going to be much more robust, perhaps even as high as 8 to 10% net of fees over time. Another pro of the VUL is that many companies offer a 0% loan, and some companies even offer a guaranteed 0% loan. That means you'll never be in a position where the cost of borrowing a loan can sink your policy and saddle you with a massive tax bill and the loss of your death benefit. Now, these high rates of returns and guaranteed loan provisions are not without their downside. As I explained in my best-selling book, Look Before You LIRP, VUL has an Achilles heel that most people don't talk about. In order to understand this Achilles heel, you have to understand the relationship between your cash value and the amount of life insurance you're paying for in a given year. Let me set this discussion up with a formula. When it comes to LIRPs, cash value plus the amount of life insurance you're paying for in any given year equals your death benefit. So for example, let's say in the first day of your policy you have no cash value and your death benefit is $500,000. That means you're paying for $500,000 of life insurance at that point in your policy. Now, let's fast forward to the 15th year, and let's say at that point you have $250,000 of cash value. How much life insurance are you paying for in that year? Well, let's go back to our formula. Cash value plus the amount of life insurance you're paying for in a given year equals your total death benefit. So the answer is $250,000. Here's where the VUL can come back to bite you. Let's say that you're in your mid-60s and your VUL takes a hit in the stock market. Let's say it goes down 20%. What happens to the amount of life insurance you're going to be paying for that year? Well, if your cash value has gone down to $200,000, as in the previous example, then you're now paying for $300,000 of life insurance, which means your cost of insurance just went up, potentially driving your cash value down even further. So if the stock market goes down and your cost of insurance goes up, and you're taking withdrawals or loans from the policy all the while, then you risk a perfect storm that could send your policy into a death spiral from which it never recovers. Now, all this said, I do personally own a VUL. Here's the key. If you go down the VUL path, you have to make sure that you have many other tax-free streams of income you can draw upon in the meantime so that you can give your VUL's cash value a chance to recover from those down years. The third type of LIRP I'll discuss today is Indexed Universal Life, also known as IUL. With the IUL, the growth of your cash value is linked to the upward movement of a stock market index. Let's say the S&P 500. If the index goes up, you participate in that growth up to a cap, let's say 12%. If that index goes down, they simply credit you as zero. So the credit you receive in any given year might be anywhere between 0 and 12%. That means you might expect to receive anywhere from 5 to 7% net of fees over time. Because of that guarantee that you'll never get credited less than a zero, you won't ever find yourself in a position where your cash value drops precipitously in any given year, with the corresponding increase in life insurance expenses. Remember, with the VUL, if your sub-accounts go down by 20%, then the amount of insurance you pay for goes up proportionally. Because your IUL will never get credited less than zero, you aren't exposed to that same type of risk. Granted, if you do get credited as zero in any given year, you will still be paying for the cost of insurance and other administrative fees, so your cash value could go down slightly. So, in contrast to the whole life policy where your cash value never goes down, you could in theory experience some loss in your IUL, although modest in comparison to the VUL. Another downside of the IUL is that you won't be experiencing the types of stock market returns you might experience in your VUL. Again, we're talking 5 to 7% net of fees over time. So your IUL is really not designed to replace the stock market portion of your portfolio. Instead, IUL delivers what I like to call safe and productive growth. Think about it. If you can get 5 to 7% growth without taking any more risk than what you're accustomed to taking in your savings account, that's a pretty safe and productive way to grow at least a portion of your portfolio. Again, when it comes to LIRPs, there is no perfect solution. All three of the LIRPs we discussed today have unique attributes that make them worth considering. Your job is to find the LIRP that gives you the most upside with the least potential downside for your financial situation. Most of my clients are between ages 50 and 65, which is why I tend to recommend Index Universal Life. For someone that's approaching retirement, it tends to provide the most productive rates of return with the least amount of risk, all the while guaranteeing that loans can be taken tax-free and cost-free. Again, the topic of which LIRP is the best can be fraught, as there are many competing voices within the financial advisor community who have a vested interest in their particular brand of LIRP. If you want to delve deeper into this discussion, check out my best-selling book, Look Before You LIRP. You can buy it in single copies at Amazon or in bulk at davidmcknightbooks.com. If you have any questions or comments, feel free to drop them into the comment section below. I respond to every single one of them personally. And if you want any help finding the right LIRP for you at your particular season in life, head on over to davidmcknight.com and click on the Work with David button. I'm happy to lend a hand. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.